Hello, I'm Stephen Malinak, head of the StarMine team in San Francisco. In this video, I'll give you a brief intro to each of the StarMine models in Eikon. Let's start with our classic quant factors, which are then combined to form the StarMine value momentum model. StarMine is best known for its analyst revisions model. ARM brings together just about everything we know about changes in analyst sentiment. We look at multiple measures of profitability, revenue, EBITDA, and earnings. We look at multiple fiscal periods. We also look at changes in recommendations. This model takes full advantage of our proprietary smart estimates, which put more weight on the recent estimates from more accurate analysts. The model also incorporates predicted surprises, which are the percentage difference between smart estimates and the consensus. Price momentum looks at signals based purely on price and volatility over different time horizons. We consider long-term price momentum, 6 to 12 month, medium-term, 3 month, short-term, 1 to 2 weeks, and industry, 1 month. We highlight companies quietly moving up or down versus those with noisy price action. Intrinsic valuation looks at longer-term earnings forecasts, including FY3, FY4, and long-term growth. We adjust these forecasts for optimism bias and reversion to the mean, based on comparison of past forecasts to what actually happened. We then use a classic dividend discount model to calculate the value at which the stock should theoretically be trading. This chart shows how well the stock is tracking its intrinsic value. In this case, intrinsic value is a good leading indicator of future stock price. We also calculate the market implied growth rate for comparison to what the analysts are forecasting. Relative valuation looks at a stock the way a banker would, using 6 commonly used valuation ratios. We look at where the stock has been over the past 12 months. We also look at forecasts for the next 12 months, again using our StarMine smart estimates. The 1 to 100 value momentum score brings all 4 of these models together into a single score. By combining value and momentum, Valmo differentiates between value traps and stocks that are truly undervalued and gaining favor with investors. Scores in the top 10% are bright green, scores in the bottom 10% are bright red. Next, let's look at quality and credit risk models. Earnings quality considers the sustainability of a company's earnings. Are they more likely to persist or fade away? The accruals component looks to see if earnings are propped up by early revenue recognition or deferred expenses. Cash is king, and the cash flow component looks for solid, reliable, free cash flow to back up earnings. Operating efficiency rewards solid profit margins and strong asset turnover. The exclusions component looks for companies that try to focus on more favorable pro forma earnings rather than official GAAP earnings. Next, let's look at our first credit model, structural credit risk. This paradigm was born as a Nobel Prize-winning idea in 1973. We can use it to model the equity of a company as an option. This enables us to calculate the probability of default based on just 3 inputs: leverage, how much a company owes relative to its assets; volatility, how big the price movements are from day to day; and drift, is the price generally headed up or down. Text mining is a more novel approach to credit risk. This model uses the latest techniques from the big data movement. We train computers to dig through transcripts, news, statements, and select broker research to see if there are telltale signs of deteriorating credit in the footnotes or elsewhere. It's good to know, for instance, if a company has publicly declared it's violated its debt covenants and may no longer be a going concern. In a future release, we'll have a model detail page for smart ratios as well. This credit risk model looks at standard financial ratios as a measure of a company's likelihood of default over the next year. Our smart ratios model also makes full use of our StarMine smart estimates where available. Soon you'll also see a single score for combined credit risk that brings the 3 component credit risk scores together in the most intelligent way for each company. Finally, we have 3 models based on ownership information. Smart Holdings is available globally. Short interest and insider filings are currently US-only models. Our Smart Holdings model begins by determining what factors are popular with institutional fund managers. To see what's popular right now, sort by factor popularity. To see the factors upon which a stock does well, sort by the stock's global percentile. Stocks that line up well with current institutional preferences will get higher scores. Stocks passing an increasing number of fund manager screens over time get an added boost from the change component. We don't have detailed pages for our two US-only models in Eikon yet, but you can see the scores in the Models widget. The underlying detail pages are currently available in StarMine Professional and will show up in Eikon in a future release. Our short interest model is based on the observation that the most heavily shorted stocks do indeed tend to go down over time. Stocks not widely held by institutions, but which are heavily shorted, are even more likely to go down. This is because stocks that are hard to borrow, yet heavily shorted, represent stronger conviction by the shorts. We frequently get the question, what about the short squeeze? We do find heavily shorted stocks do get squeezed upward from time to time, but the propensity to squeeze is more tied to the volatility of the stock. We provide a separate short squeeze indicator to flag stocks likely to get squeezed. The Insider Filings model, US, is our latest StarMine model. This one tracks all buying and selling activity by company insiders as required by Sarbanes-Oxley. We have found it pays to look at insider filings from multiple perspectives. We provide a net buyer ratio, buying depth, and selling depth for each US company. We take into account there are many reasons someone might sell a stock, for instance, getting options as compensation. Please visit Alpha Now to learn about these models and see recent examples of the models in action. For Thomson Reuters, I'm Stephen Malinak.